Jumbo mortgage rates are a bargain, our insurance companies sneaking around on your social media, and Floyd Mayweather has a whole lot of cash. You're in the right place, folks, because this is where the money is. Welcome to the show, folks. I'm Matt Copenheffer, and as always, right beside me is David Hanson. We've got a great show today, folks. On the kickoff of the NFL football season, David and I are going to look back at the fantasy stock draft and review our round 4 picks. We're also going to be playing a round of Rank It with insurance stocks. But as always, David, we're going to start with the headlines.
Let's do it.
And we're going to turn to the Fed. You love the Fed. We'll talk a little bit about the Fed. Yesterday, the Fed released its Beige Book report. The LA Times headline was, Fed's Beige Book reports moderate growth in most of the nation. Moderate growth. Fantastic news, right?
Shocker. I was really expecting 10% growth and huge economic growth. I mean, this sort of thing, I don't think investors are paying too much attention to it anymore. It's kind of just more of what we have already heard. It's moderate growth out there. Anyone you ask can say, the economy's growing, but it's not great.
It's actually exactly what we've heard. And I pulled up the Beige Book report from July. So here's what the September Beige Book report said. The first line. Reports from the 12 Federal Reserve districts suggest that national economic activity continued to expand at a modest to moderate pace during the reporting period of early July through late August. Here's July. Reports from the 12 Federal Reserve districts indicate that overall economic activity continued to increase at a modest to moderate pace since the previous survey. It's the same.
Right.
There's no, and here's one other, when we're thinking about areas of the Beige Book report that we might be specifically interested in the September report, for most occupations and industries, hiring, there's the jobs, hiring held steady or increased modestly relative to the prior reporting period. Here's July. Hiring held steady or increased at a measured pace in most districts, with some contacts noting reluctance to hire permanent or full-time workers. Maybe we can sense a little bit of an improvement there, but yeah, we're on this slow but steady path, and this seems to continue that.
Right. All right. Moving on to the second one, we're going to the New York Times. U.S. auto sales gained in double digits in August. Good news for the auto industry. We saw Ford post some impressive results. What does this mean for the banks that have moved into the auto lending space? I'm assuming this is good news for them.
This is terrible. No, of course this is good news. It's the trouble would be if they're not making good loans, and certainly there's the potential for that. We're in this low interest rate environment, and there's a potential to get excited to make loans that the buyers aren't going to be able to afford. But overall, I like the banks moving further into auto sales or auto financing and challenging the incumbent, now known as Ally Financial. Ally Financial is still the number one auto lender, but Wells Fargo, right up there, close behind JP Morgan, up there as well. And then Capital One and Bank of America round out the top 5 auto lenders. And I like that movement, and the more cars that are obviously sold, the more financing that buyers are going to need.
Yeah, I think it's a good move for the banks. You look at auto lending, it's a little bit of a juicier interest rate on that as opposed to a mortgage or something like that, or opposed to going out and buying corporate securities and holding them on your books. So you're getting a nice interest rate there. And as long as you're making good loans, it's a good move. And when we look at something like the Fed's survey of loan officers, we haven't seen consumer credit standards ease that much. The easing has been a little bit more on the business side. So I think we can be fairly confident. I know we don't want to get too confident that the banks are always making good loans, because we saw that's obviously not the case.
Not even close.
But I think if you own a bank stock that is making more auto loans, I think you should feel pretty good about it.
Third headline of the day, Wall Street Journal headline is Jumbo Rates Reach Milestone. This is about the jumbo mortgage rates. Here's what the article said. Mortgage rates dropped last week with rates on jumbo mortgages, those that are too large for government backing, falling below rates on conforming loans for the second straight week, according to a survey released Wednesday. Why should we care about this?
It's a little bit unprecedented. That's the word that I heard thrown around a little bit. We haven't really seen this in the past, where conforming, which are loans that usually get sold off to Fannie Mae and Freddie Mac, that's usually a lower rate than the jumbo loans, which are bigger, usually not, or they're not securitized when they're not non-conforming there. So there's a lot of factors that play into this. Some of it has to deal with changes with Fannie Mae and Freddie Mac and their standards and how that flows through to the borrower. But some of this is the banks making loans to very credit-worthy borrowers, which is what jumbo borrowers usually are. They're usually wealthy individuals, good credit history. So the banks, they have all these deposits. There's not a lot of places to put them in an attractive yield environment right now. And they look at these jumbo borrowers and they say, well, we can get a nice interest rate on this. So that the competition is there to get those borrowers. And maybe if we give them a mortgage, like if you're Wells Fargo, if you give someone a mortgage, maybe they'll bring on their investment accounts with you. Maybe they'll bring over their savings accounts with you. So that's kind of the strategy that's playing out for the big banks.
Well, you mentioned it on auto loans. They have to be good loans. They do have to be good loans. This maybe worries me a little bit from that perspective, that maybe there's a little bit of over-exuberance from the banks lending on these jumbo loans. But at the same time, where's the advantage? In the auto loans, in the credit cards, it's a higher interest rate. Here, I think like you said, there is the aspect of better, they require more down payments typically for a jumbo. They require typically higher credit ratings, particularly to get the best rates. And then also there's the relationship angle too. So I think that there are a lot of advantages to these jumbo loans, and also they've got a lot of balance sheet funding that they need to put to work, and this is one way to do it. All right, moving on. We had our fantasy stock draft, and we've been through and reviewed rounds 1 through 3. Now let's move on to round 4 and take a look at where we may have done well or made a mistake in our drafting strategy. Why don't you kick us off?
I think I got a steal in round 4.
Of course you think that.
We only did 5 rounds, so this is near the bottom of the pack there. I took PNC Financial Services, based out of Pittsburgh there. So the bank has really expanded the last couple of years. Financial crisis hit. A lot of banks had to really scale back, obviously. Liquidity was a big concern. When banks were at these dirt cheap prices, not a lot of banks could take advantage of that and go out and pick some of these up. PNC was one of those banks that was in a good position. They were able to go out, make some good acquisitions. They acquired RBC Bank, the U.S. operations there, so they expanded their retail footprint, so their customer business, their retail customer business down into the Southeast and North Carolina, South Carolina, that area of the country. And the reason I think it's a good pick and a good stock today, or an attractive stock today, is the valuation. They made all these acquisitions. I think that's weighing down the valuation a little bit. It trades at 1.4 times tangible book. And to give you some comparison, JP Morgan, which is another stock that I drafted first overall in the draft, it's trading at about 1.3 times tangible book. Now, JP Morgan's producing a little bit better returns than PNC right now. But over the long run...
Worse headlines.
But worse headlines, for sure. But over the long run, I see the earnings potential from a returns on equity perspective of these banks to be pretty similar. I like the business model at PNC. Around 40% of their revenue comes from that retail consumer business. 40% comes from institutional business banking, very secure lending there. The rest of it comes from asset management, and they have around a 22% stake in BlackRock, the asset manager. Sure. So there's some pros and cons to that stake in BlackRock. Some people say, well, this is great. They've had a great run with BlackRock. They make a fair amount of income off that. But there's also some concerns around what that means to their capital structure, whether they have to take that out of their regulatory capital and can count that stake as really secure capital. So there's a little bit of uncertainty there. I think that's a little bit exaggerated, the concern there. I don't see it as a problem. I think the BlackRock stake gives them tons of opportunity, tons of flexibility to do things in the future. If they want to reduce that stake and move more aggressively into other areas,
Gives them extra, yeah.
they have the ability to do that. So at 1.4 times tangible book, it's not very expensive, around 1.1 times just book value, because they do have some of that goodwill in their book, which for tangible book, you strip that out without getting too crazy into the accounting with you. So yeah, I like the business mix. It's very impressive. I can see this bank producing double-digit returns on equity every year, year in, year out. At these prices, I think it's a good pick. That's why I made it my 4th pick.
Well, just as a reminder, just for anybody who forgot, the rules of the draft were that we had to pick at least one stock from a number of different buckets. The real estate REIT bucket, bank, insurance company, consumer finance. And did we have an other bucket?
I think we called it an other.
Yeah, consumer finance / other. So this 4th pick of mine was from that consumer finance / other, and it sort of goes into that banking bucket as well, but it's Discover Financial. The interesting thing about Discover, the opportunity with Discover, is when we think about the credit card industry, the payment networks, the move from cash-based transactions to card-based and online-based, that's huge. And Discover certainly isn't the first name that comes to most people in mind. You've got MasterCard, you've got Visa, and then really probably you've got American Express before you even think about Discover. Right. So to me, that suggests opportunity. So there's opportunity for them to gain market share if they can do it. I think there's opportunity, some opportunity in the U.S., particularly from that market share perspective. Globally, I think for all of the above, for American Express, Visa, MasterCard, and Discover, there's even more opportunity. So we hear the number tossed around a lot that 85% of transactions globally still happen with cash. And that's not the U.S. That doesn't represent the U.S. really at all. But globally, so you can think that the skew is so much more towards cash-based outside of the U.S. So I think that there's a lot of opportunity from that perspective. However, there are some concerns that I have to face up to with Discover. So the credit card and the payment network business, those are big businesses for Discover. That's kind of the core. And we saw we've already seen debit card transaction fees come under fire. The credit card business itself, the financing of it is I don't know. I just think that that's one that's always going to be in regulators' crosshairs because people get into a lot of trouble, putting themselves into a lot of debt using credit cards. So I think that there's always the potential for tighter regulation that hurts this kind of business. So that's something that I have to keep in mind. Discover is also a big student loan provider, and that is an industry that's come under a lot of fire in recent years. And I think that there's probably a crackdown on the come there. And I don't know how much credence to put in this, but there's as university educations get more and more expensive, there's a lot more talk that comes of, well, do you really need to spend all of that money and go to college, or can you just set out on your own and be entrepreneurial and all this sort of thing? Look at Bill Gates and other folks who, I don't know how much I want to put into that, but if there was a slowing or some tarnishing of the idea that a university education is an absolute essential, that hurts that kind of business. On the results side, Discover has delivered. I mean, if you look at recent returns on equity, returns on assets, if you look at the credit quality, good and improving. So, I pair the results with the potential opportunity, and I like it. There's more digging that I want to do on this because I think that there are some real risks here. But again, the recent results and the opportunity that I see down the road, and I think the sort of hidden nature, it's sort of hidden in plain sight in that you say Discover and people aren't like, well, what's that company? But you say credit card industry and you've got Visa, MasterCard, American Express, and then down the line Discover. So I think there's opportunity there. So I'm happy with my fourth round pick. I think I may end up being even happier as I get to know it even better.
Oh, yeah, I think it's a good pick. And you look at David Nelms, the CEO there, like you said, they've really delivered. And you just think about, it's not really the brand recognition here in the US, but you mentioned the international expansion. Discover has a little bit of a tarnished feel here. It's not accepted everywhere. If they can really branch out internationally and get a foothold somewhere, that reputation won't really matter internationally because it won't be there. So I think there's great opportunity with Discover.
Okay, from the picks that we made to the picks that we're going to make, let's play a little Rank It, David. Today we are looking at the insurance industry, and we've got 5 insurance stocks here. Genworth Financial, Universal Insurance Holdings, Marsh & McLennan, China Life, and White Mountain Insurance.
Yep.
Rank them, David.
All right.
1 to 5. What order would you put these 5 stocks in?
All right, we'll throw up my rankings here. And the first one I have on there is Marsh & McLennan. The second one, Genworth. Third, Universal Insurance Holdings. Fourth, White Mountain. And 5, China Life Insurance. So the first one on there, it's interesting. When I was digging on this company a little bit more, Stock's had a good run the last couple of years or so. It's still not back to its all-time high, which happened back in 2004, right before Elliot Spitzer accused them of insurance bid rigging, if I can even say it, and steering clients to certain insurers. So they're an insurance broker matching their clients to certain insurance companies around the world. The suit was eventually settled, took a big loss on that suit. But going forward, this is a very diversified company with a lot of operations. It doesn't look like it's trading at a very expensive price. With that diversity, with that price, with all of their areas internationally here in the U.S. as well, I think there could be good opportunity for them going forward. I'll bat it back to you, and we'll go back and forth here. What was your number one?
Well, actually, my number one, and we can see my rankings up here as well, just to see how they differ from David's, but you can see my number one, same as yours, similar story. And we're looking at the insurance industry here. Marsh & McLennan, not an insurer, insurance brokerage. Right. And so this gives it a little bit of a different flavor from the other companies we're looking at here. And a little bit less risk too, because you don't have that, with the property and casualty insurers, you have this exposure to catastrophes, where you're going to have these years where you're going to add up the profits, and then you're going to have a big catastrophe that's going to really hit the bottom line, so you've got to average it out over the years. Ideally, Marsh isn't going to perform like that. It's going to be sort of year in and year out. And I think of it sort of as a consultancy, because people are going there. It's basically a risk consultancy. How do we lay off this risk? Where do we lay it off? And they're one of the experts in the field. So if you think about them similar to an Accenture or a Goldman Sachs of the insurance industry.
Right. I'll group the next two together, my 2 and 3. I have Genworth and Universal Insurance Holdings. So Genworth, the U.S. mortgage insurance business, that's what got them into trouble after the crisis, obviously, if they're insuring these mortgages. The life insurance part of the business, it wasn't hit that hard. That wasn't really the problem. It was really the mortgage insurance business. So going forward, this stock is still dirt cheap on a price to book level basis. Going forward, I think the mortgage business will continue to recover. The life insurance business is still there. So I think there's opportunity for them still to get back on the road to recovery. The third, Universal Insurance Holdings, they're almost entirely in Florida home insurance. We were talking to one of our interns, I think, about a month ago, and he was looking at an insurer that specializes in Florida home insurance. And he mentioned there really hasn't been a catastrophe, a hurricane, in Florida recently. So a lot of these Florida-based insurers, or these insurers that focus on Florida, they've really been doing great because they've been collecting all these premiums. They haven't had to pay out anything. So they've been performing well, but they're third on my list just because it makes me a little uneasy with that. What about you?
So your number 2 is Genworth. Genworth I have as my number 3. I actually own a very small position in that in my personal portfolio, and that's largely on valuation. I think you're right. I think there's potential for Genworth to come back. I'm not crazy about the mortgage insurance business in general, and the life insurance business is a really difficult one right now because of the low interest rates. And I just don't think of Genworth as a leader in that business. They're there. And so I'm not crazy about it, but I think because of valuation, it made my number 3. My number 2, where you had Genworth, I have White Mountain. White Mountain is, it's basically a holding company for a number of different insurers. One Beacon is one of them, a specialty insurer, and it has other specialty insurance operations underneath it as well. I see White Mountain, and in particular, in One Beacon as well, which is also a publicly traded company. I believe the ticker is OB there. Very good insurer, very solid insurer. I think in the mold of a Berkshire Hathaway type insurance company, and focus is on underwriting and underwriting results, not on growth, not on premiums. And actually what we've seen is the premium level at White Mountain has gone down over the past few years. It hasn't been a great market for insurers. The premium levels in terms of the risk that poses hasn't been great. So you've seen the better insurers shrink their premiums a little bit, and we've seen that at White Mountain. But I think long term, White Mountain is a good solid insurer to own. That's why it's my number 2. Your number 3, Universal. Hate that pick. Hate it. That was my number 5, and it's not something that you missed. It's actually something that you pointed out, that there have not been. So Hurricane Charlie in 2004 was a really major hit to the Florida market. Universal was in business in 2004, but not doing much business. 2005 was a relatively active hurricane season as well in Florida. Universal still wasn't doing much business then. 2006 on is when Universal really started its hockey stick growth trajectory on the premium side. There hasn't been a major hurricane in Florida since 2005. And that is, I would say, if anything, that's a bit of an aberration. Having gone to school in Miami, I'm sure you probably know that better than I do. And so I'd be concerned that it's not a cheap stock right now as an insurance stock. And so I'd be very, very concerned as to what happens when there is a major hurricane. They've laid off some of their coverage into reinsurance contracts, and that could provide them some protection. But Universal for me is a solid number 5 on this list.
Fair enough. All right, I'll wrap out my rankings here with I had White Mountains number 4, and then China Life Insurance down at number 5. White Mountain, they gave me a little bit of pause because of their investment philosophy. You mentioned them a little bit Berkshire-esque in terms of focusing on underwriting. The investment side gives me a little bit more pause in terms of how they're allocated and their history of investment performance. Had some big losses in 2009 with their investment portfolio. They're still fairly exposed to a lot of private equity, hedge funds, the equity markets. And I love to see that in strong insurers like a Berkshire that have a proven track record of doing well in the equity markets. I can't get as comfortable with what they're doing with their investment portfolio, so that's why they're number 4. And China Life, I'm not that familiar with it, and I'm going to stay within my circle of competence. I don't know that much about it, so not saying it's a bad company, but if we focus on what we know, that's not something I'm very familiar with. So that's why I stuck it down there at number 5. Full disclosure.
China Life was my number 4, and I'm pretty much on the same page as you. It got into our list here. I'm not as familiar with it, but what I do know is that China has seen some struggles recently, and that gives me a little bit of pause. So that, combined with the fact that I'm not as familiar with the company as I am with some of these others, was number 4. Could have been a number 5 as well for me.
But Universal
if it
just
weren't
wasn't cutting it.
Universal, I would buy China Life and short Universal before I did anything else. Although I probably wouldn't actually short Universal. That is the kind of stock that you could lose your shirt on shorting.
Right.
If nature does not cooperate and offer up a good hurricane sooner rather than later. So finishing off here, as always, we go to the Twitter sphere. And David, why don't you take us out?
All right, let's fire through some of these. The first one we got, Dick Beauvais. He says, JP Morgan likely to spin off asset management division. And he links out to a Value Walk article there, and that's from Value Walk. So this isn't a report, okay, first of all. JP Morgan has not come out and said they're spinning off their asset management division before anyone starts freaking out if you're a JP Morgan shareholder. But as a JP Morgan shareholder, if they did spin off the asset management division, is that something that would upset you?
It would depend on the circumstances of why they separated it out. Dick Beauvais has been pretty vocal about JP Morgan and the headlines that they've been facing, saying that it looks like there's a vendetta that the government has against JP Morgan. I don't think he's totally out in outer space on that. It does have a little bit of that flavor. If the pressure from the government, from the pressure of the investigations, basically forced them to spin off the asset management division, that would give me a little bit of pause. I would worry about that. But if they spun it off because they think it would unlock value, create value for shareholders, I don't think that's a bad thing. And the important thing to remember is that it just doesn't get jettisoned and go off into outer space. That's value. That's still value for JP Morgan shareholders. And it could even, and I've talked about this before, when people talk about breaking up the big banks, when you break them up into pieces, the current shareholders get the value. And sometimes what you can have is when you have more clarity of this is what this business is, this is what this business is, you can get higher valuations, and that can lead to more value for shareholders.
Right.
So moving on to the second tweet, we've got Todd Sullivan, that's at Todd Sullivan. Says, is your car insurance company using Facebook to spy on you? And he links out to an article on Edmunds. David, is your insurance company spying on you?
I guess so. I mean, it makes sense. And the article is talking about people that file claims, say, oh, I hurt my back in this accident, and then the insurance companies go on Facebook and they see him playing 18 holes of golf or tweeting about 18 holes of golf. I thought it was pretty interesting, and it makes sense. Obviously, these insurance companies are going to fight tooth and nail, whether they have to do it through Facebook, Twitter, whether you're tweeting about helping a friend move when you say you can't lift anything. From an insurance company's perspective, it's a good thing if it gets rid of these people that are making false claims. And I think it goes to show you that as we get better technology, not just this using Twitter and Facebook, but when you look at a company like Progressive with a snapshot that kind of tracks your driving preferences, I think this is the model that we're going to move towards. It's going to hopefully help insurance.
The model of Big Brother Insurance.
It's going to help insurance companies hopefully price risk a little bit better, and that could be a long-term good thing.
I can see outcries here about privacy concerns and that kind of thing. It's hard to feel too sorry for people who are trying to cheat the insurance company.
Right.
So.
All right, moving on to our last one. Got it from Darren Ravel, at Darren Ravel. Insane! Floyd Mayweather has all his saved money, $123 million in a single bank account. And he links that to an article on ESPN there. Matt, do you have all your $123 million in one bank account?
Yes, all $123
dollars.
Yeah, all 123 Zimbabwean dollars.
Yes.
I hope Darren Ravel let Floyd Mayweather know what the FDIC insurance level is, because if anything happens to that bank, Floyd Mayweather is not going to be a happy camper, because most of that $123 million is not insured in a single account. And P.S., if Floyd Mayweather is watching this, and I know he probably is, he needs to get himself a subscription to one of the Motley Fool newsletters, or at least start reading Fool.com. There's a lot that can be done with $123 million instead of just having it sitting there as cash in a single bank account where it could disappear.
In order to have it all FDIC insured, he would need almost 500 bank accounts.
That would be a lot of work. You know what? I will make the offer, too, that if Floyd Mayweather wants to hire me as his bank account specialist to manage his bank accounts,
You can do that.
I would consider doing that.
Small fee, 1%. It's fair enough.
Yeah, 2%. Maybe hedge fund kind of money.
Yeah.
2% and 20% of any of the gains from the. I can put some of it into Bank of the Internet,
There you
where I
go.
can get good returns for him on it.
Everybody wins.
Everybody wins.
Yep.
Everybody, David. As always, people on the show may have interests in the stocks that we are talking about, and the Motley Fool may have recommendations for or against, so don't buy or sell solely on what you hear. Again, I'm Matt Copenheffer with David Hansen. Thanks for watching, folks. We'll see you tomorrow.